Thanks very much. Welcome, everybody. It's so nice to have you all here. I think we have hopefully some people viewing as well from home, and a big welcome to our MTNers across the footprint who are watching today. We're very excited about the results, so I'll do my best to stay calm as we go through them, but excuse me if I'm jumping around a bit. We have the highlights up for you on the screen behind me. A couple of key messages I wanted to draw out. Firstly, constant currency service revenue growth, 10.7%. A year ago, that was 7.2%, and remember that our medium-term guidance for constant currency service revenue was high single digit. So I think a very strong operational performance on revenue. Two big drivers of that. Firstly, access data, so 22%. You see it's almost a 30 billion rand business. And thirdly, fintech. So one of the things you're going to see as we go through the results is that we have split the fintech businesses out of that broader digital category. So when we talk fintech, we're talking about mobile money, airtime lending, insurance, micro deposits, microloans. That's all in one bucket of revenue. When we talk digital, we're talking now a combination of the old value-added service business and the newer rich media messaging, mobile advertising businesses. So very strong growth in data revenue, 22%. Almost 50% growth in fintech. I've got a slide on that a bit later as we talk about the prospects going forward. Remember, if it's growing more than 40%, it's doubling every 2 years. Major growth engine of the group. I think we were also very pleased with the progress on efficiencies. So we have guidance to improve our margin. Group EBITDA margin improved significantly, driven off the back of considerable margin improvements in both South Africa and Nigeria. That's why you see EBITDA growing at 15.9%. That's a constant currency metric, so adjusted back into constant currency for the 2 years. But even if we put that EBITDA growth into reported currency, it was up 14.4%. So we've got real significant growth in EBITDA coming through the business. CapEx, I think, well contained, 26 billion. You know, we've had CapEx intensity guidance to bring it below 20% and then bring it towards 15% on the old accounting standards. So the first time that you see the group CapEx intensity falling below 20%. Ralph's going to show you a bit later that we got just as much bang for our buck for the same CapEx, because we're leveraging historical investments, we're bringing down the unit cost, also building our new age digital and fintech businesses, which aren't really consuming as much CapEx as the core mobile business. Standout feature for the group's results this year is the stabilization of leverage. So remember that our leverage, the holdco leverage that we use, was around 2.7 last year, went up to 2.9 at the half year. We have a guidance range to bring it below 2.5. We've come in at 2.3 for the full year. So stabilization of leverage, bringing us back into our target, super important. I think with the strong momentum, the strong results, we feel very confident also with the dividend. So we've met our dividend guidance of 5 Rand a share, and what you see on the slide there is the second half dividend of 3.25 Rand. So really important that despite all the challenges we had in the year, we hit all our medium-term guidance, and leverage and dividend all looking very strong. Take you through a little bit of the operations. So I've got a slide, SA Nigeria. I'll talk to the regions. I'll talk to our 100, 200, 300, and then a little bit on the investments and the associates. So I think if you look at the South African performance, we really, I think, are able to say now that we've turned the corner. You see some of the metrics on the slide. I mean, service revenue was 4.2% for the year, back into our guidance range. We think that benchmarks very well with the competition, and we need to say plain and clear today that we are drawing the line in market share losses in MTN South Africa. What we've given up, we've given up. From now on, we're going forward, we're competing, and we're not going to be losing any further market share. Look at the subscriber numbers. Overall subscribers up 1.7 million. Another 400,000 in postpaid. That was a real Achilles heel of the group the last few years. The consumer postpaid business is doing very well. You see at the top right-hand part of the slide, service revenue growth, consumer postpaid, 16%. Very strong performance also in data. So you see the growth in the data subs, the left-hand side of the slide, up 1.2 million. We have over a 40% penetration now of active data into the base. And you see on the right-hand side of the slide that drove almost a 13% growth in data revenue. So certainly for MTN South Africa, access data is still a big growth area going forward. Also very pleased with the progress on the network. Giovanni is here. He's the CTIO in MTN South Africa. Him and his team, I think, have really made a massive impact there. The network has been best tested by a number of different metrics. Most recently, very auspicious European consulting firm. I'm not allowed to mention the name because I'd have to pay them some money, which we're trying to save money, of course. We came up with a 68-point lead in the market, 68 points higher than the next best network. That same test a year ago, we were around 38 points higher. So actually the gap is opening up. I can say to you point blank now, we have the biggest, best network in South Africa by a significant margin. Full stop. Now, of course, also the results were strengthened in Q4 by onboarding the Cell C roaming deal, and that's a multi-year deal, so that's going to be helping our results going forward. But even if you strip that out and you looked at the revenue performance against the competition, you'll see that MTN South Africa is benchmarking well. So I think very strong performance. Well done to Godfrey and the team. We know one of the big dragons we've got to slay this year is getting our enterprise business back to growth. Still dragging the results a bit. Once that comes into growth, you're going to see an even stronger performance. Let's look at Nigeria. I think also super strong performance. Revenue growth up 17%. Look at the subscriber numbers. Some of you may remember that we had subscribers around 61 million. We changed our definitions. We dropped it down to the early 50s. We took out subscribers that were only in the system because they were receiving bulk SMS. They weren't really active. We've rebuilt it back now to more than 58 million. It's more than 6 million, or just under 6 million net adds in one 12-month period. Also particularly strong in the data business. So data business is up 4.5 million. You see 18.7 million on the slide. That's about a third of the customers now active data. Look at the revenue growth on the right. 40% growth in data revenues in Nigeria, or for 56% traffic growth. So what that tells you is if we have very low data pricing in Nigeria, which is why we can turn most of the customer adoption and increased usage to revenue. A very, very strong case for data monetization in Nigeria. Also really pleased with the progress on the network. Nigeria is all about smart CapEx. You've got to look at where are the people, where are the activity, what's the distribution of handsets. We've lifted the 3G population coverage up to 70%. The vast bulk of the handsets in the Nigerian market are still 3G handsets. Now we know we've got about 4.5 million LTE devices on the network, which is why we're pushing the 4G coverage into the metro areas where the handsets are. We've increased that up now to 14 cities. Generally, if you look at the Nigerian network compared to the competitor networks, on external valuations, on Facebook data, that network is performing much better with almost 50% more customers and 50% more traffic. So again, I think we've invested well. We are ahead of the investment curve. We are ready to receive more data customers and more traffic in the Nigerian OpCo. What we do now is we then look at the rest of the consolidated subsidiaries in three groups: SIGA, Weka, and MENA. Interesting, if you just look at the profile of the group, we've got around 20 billion rand businesses in SIGA and Weka, and about a 9 billion rand business in MENA. The results, generally, I think you can see the pressure point is in the middle, in the West African portfolio, primarily driven by Côte d'Ivoire and Cameroon, that had minus around 7% service revenue growth in the year. We've got very good recovery plans for the markets. Part of it was also just the general macro and socioeconomic stability in the markets. So pretty sure that we're going to lift those up. On the outer sides of it, I think decent performance. I mean, these are both regions growing at 20% constant currency. The group's growing at 10.7. So they are positively contributing to the service trajectory of the group, positively contributing also, of course, to the subscriber growth. Particular standout result in these markets is MTN Ghana. Very, very strong performance there. If we look at our famous 100, 200, 300, which is a slightly different cut of the results, you'll remember that when we launched the Bright strategy, we said, if you wanted to remember three numbers, what are we trying to do? We are trying to grow the overall subscriber base from what at that stage was 217 million to 300 million over the medium term. Population growth, people penetration, market share gains. And at the same time, we wanted to take active data as a percentage of that base from less than a third to 2/3. So 300 customers, 200 million on active data. And the third thing we said was that we committed to playing a meaningful role in digital services. Okay? our fortunes are not to simply be the connectivity provider. We want to play in the services that you see on the front screen of your smartphone. And the target was to build up a base of 100 million customers, 50% of the digital customers consuming an MTN-owned digital service. So how have we done? Top left, you see voice, or total subs, of course, also voice, 16 million net adds for a year. So, of course, we know that around 5.9 million is in Nigeria, means there's decent subscriber growth across many of the markets. Very interesting that round about 55% of our total revenue now is voice. So we've built up the other revenue streams quite well. It's growing 7.3% in 2018. And it was growing 6.2% in the first half of 2018. So I'm going to make a very strong argument for you later on that voice is a growing revenue stream for MTN Group going forward. On the right-hand side, you see data. So we picked up almost 10 million active data subs in the year, bringing the penetration now to roughly a third, strong growth in data revenue, and a big push out in coverage. 434 million now across a population of about 660 with a decent layer of 3G coverage. Really what you see in these markets now is that the network investment, the 3G coverage, is way ahead of the adoption of the service. So I think we're investing ahead of the demand. Bottom left of the slide is all about fintech. So we started the year around 22 million 30-day active subs. We built it up to 27 million. That is 27 million active transactional financial services customers on an MTN network. You can compare that to some of the very valuable stocks in the South African context. Capitec, market cap of more than 100 billion rand, around 10 million active transactional customers. This is 2.5 times the active base of a company like that. Just to give you a little bit of perspective, it's almost an 8 billion rand revenue business, and that is before we launch it in our two largest markets. So of course you could say, well, that's the three good quarters of the slide, and on the bottom right we have a slightly more troublesome quarter. And that is really our digital revenues. And what is sitting in the digital revenues now are our old value-added services revenues, things that you would remember from 5 or 10 years ago in the industry, caller ringback tones, messages, religious messages, weather, the things that we used to get on a 2G basic phone in the world before the smartphone. And that is a revenue stream that is under a tremendous amount of pressure. Because as you move from a basic phone to a smartphone, no more are you going to pay for a subscription service for weather. Okay, you're just going to go onto weather and it's going to tell you what the weather is. Or as I tell my wife, you can look outside, also tell you what the weather is, but be that as it may. So this is a revenue stream in the group results that dropped by a third in 1 year. So that's 2 billion rands worth of service revenue if it had just been flat. So when you think of that 10.7, you've got to think that's 10.7 after absorbing a 2 billion drag for VAS optimization that we're going to lap out, certainly within the next 2 to 3 quarters. And over time, that will be replaced by all of our ambitions for digital. I'm going to take you through that in a bit later. So 2 tier 1s, 3 regions, 300, 200, 100. Now, our comment we often get on MTN is, that's clear, thank you, but what's happening with the associates and the joint ventures and the investments and the tower companies? So really in this results, we want to be crystal clear about what is there, what have we been doing, and what do we plan to do. So let's set out in the slide in front of you. There's 4 pieces to it. On the left-hand side, you see the consolidated subsidiaries. So these are MTN mobile assets that are consolidating into the service revenue and the EBIT targets we've been talking about today. What have we done in optimizing that portfolio? We disposed of Cyprus last year on the basis that it was our only European operation, different demographics. We sold it at 8 times EBITDA. We've also been busy with a localization. So when we listed Ghana on the Ghanaian Stock Exchange, we sold some part of it. That came back as a kind of what we call a localization. The focus going forward is we will have 3 significant localizations in 2019. We'll have the listing of Nigeria, and we plan to do localization transactions in Zambia and Uganda. So localizations. Second big theme is to continue to run our conflict markets on a cash neutral basis, that they fund their own operations. Third big focus is to return our Weka portfolio to growth, as I discussed earlier. So when we talk about portfolio review, that's where we've landed with the consolidated subs. which is around 18 of the 21 markets that are left. Then we come to the telco associates, and you see them there on the slide as well. So Irancell, the focus there is run it on a cash-neutral basis as we move through the sanctions areas. Irancell needs to fund itself. It needs to cut its jacket to suit its cloth. But going forward, we are looking for simplification there, and we announced in these results that we have signed an agreement to dispose of our investment in Mascom. So Mascom is an associate company. It's not branded MTN. We were never able to achieve a control position, and we are not able, under those circumstances, to roll our Bright strategy through there. We've been partners with Econet and Mascom for many years, and fortuitously, they've made us, I think, a very fair offer, and we will be disposing of that asset for $300 million. We plan to close that transaction in the next quarter or so. And the final thing of that portfolio is BICS, which is our carrier business. We're in the process of re-signing all of our long-term commercial arrangements for carrying voice and SMS inbound, outbound traffic. So we're busy with that. So that's the subs, that's the associates. Now what is sitting on the right-hand side of the slide is two big blocks. It's our e-commerce assets and it's our investments in tower companies. E-commerce, you know well. It's the original, what we used to call the three rocket joint ventures. So Jumia, which is the African Internet Holdings, MEIH, which is in the Middle East, and IIG, which is the Iran Internet Group. We also have investments in TravelStart and in a venture capital fund called Amadeus. What we did in the last year was basically to attract third-party funding to fund the e-commerce investments. We actually raised 155 million euros in 2018 alone. But we've taken a decision that what is important for us for that portfolio is where we have overlapping markets like Nigeria and Iran, the most important thing is a commercial integration. So for example, if you want to buy something on the Jumia marketplace, you should be able to use MTN Mobile Money. If you want to book a ride on Snap in Tehran, you should be able to use your digital banking with MTN. But we do not believe we need to own the assets, and so we are announcing today that these are not viewed as long-term strategic holdings for the group, and we will look to realize them over time. The same is very true also for the right-hand side of the slide. These are our investments in tower companies. So let me be clear on that. That's not the tower assets spread across the group, many of which are still owned by the group. It's where we sold our towers into companies like, for example, our 29% shareholding in IHS. We have a 49% shareholding in two joint ventures with ATC, Ghana, Uganda. We have some outstanding loans. Same logic. What's important is the operational integration with these companies where we are renting towers from them. We do not need to own them long term. And so again, we will be looking to monetize. The top of the slide there, you see that the e-commerce assets have a carrying value of 5 billion and that the tower companies have a carrying value of 25. Put that together, that's 30 billion. Valuation-wise, we value them on a fairly conservative basis at 40 billion. So we have 40 billion of assets that we are now declaring as not long-term strategic, available for monetization. If you put our efforts together for all four of the categories, localizations in the OpCo portfolio, rationalizing some of the associates, and realizing some of the tower portfolio, we've announced a 15 billion rand asset realization program over the next 3 years. Okay? It excludes IHS, which is 23 billion on its own. So if something comes from IHS, it would be on top of the 15 billion. Big focus on optimizing the group, simplifying, reducing risk, and improving returns. So my final slide is just a quick look at how we've done against the focus areas we set out a year ago. So this slide popped up exactly a year ago. It just didn't have the Harvey balls on the right. I'm not going to go through all of the elements. I think you can see some we did pretty well. Smart CapEx, CVM, personalized pricing, expanding data coverage. Some we've done, I think, pretty okay, but there's still work to do, like high-volume journeys. The one I wanted to single out was the difficult regulatory issues, which you see as a 50%. You know, when we went into 2018, we knew that we had challenges in two of the markets. We had frequency fee disputes in Benin. We had a lot of issues around the license in Cameroon. And I think we made good progress in resolving those issues. Of course, the second half was characterized by some really, really major events, particularly the dividend and tax issues in Nigeria, more recently a very difficult situation in Uganda. And I think we wanted to say a couple of things. Firstly, that We understand it's a big concern for investors. We take that on board. Secondly, that we are continuing to invest in our risk management, regulatory management, relationship management. Thirdly, you do see progress in resolving some of the more complex ones in 2018. There is work ahead. We do believe that our increased focus on localizations, as I discussed earlier, Ghana last year, Nigeria, Zambia, and Uganda this year, will help, and it is front of mind for the management team. Please be aware that it is being comprehensively managed. So with that, I will hand you over to Ralph for the numbers.
Rob, thanks very much, and very good morning to everybody here on our 14th Avenue campus. And we know we have people following the presentation via various media formats, and welcome to them as well. But a special greeting to all the MTNers across our markets and at head office, who give us the pleasure, Rob and I, of delivering the results that we're presenting today. So over the next 25 minutes, as part of the financial review, I aim to cover a couple of areas. Firstly, to cover the significant items that impacted our financial results for the year. I'll then highlight some salient items on the group income statement, not cover everything, but the ones that we think have been quite material. And then I'll cover our two largest markets that we consolidate, South Africa and Nigeria, and giving some detail in the way that these businesses performed. I'll come back to the income statement and give a detailed review of key line items, and then finish off with the balance sheet, cash flow statement, as well as the headline earnings per share analysis. So let's start. There were four significant items that were impacting our full year results that we've just reported. The first is the stronger average rand against the basket of currencies in the markets we operate in, where we ended up having reported growth rates being lower than our constant currency rates. But it is, however, encouraging from our perspective that we are now seeing both reported growth rates and constant currency rates positive. And so this is the first time we've had them positive for at least 2 years. The second item is a weaker closing rand against the US dollar. The average rand was 1% stronger against the dollar in the period, but closed 14% weaker. The closing rate is what we use for translating balance sheet items, so that particularly affected our holdco debt. And in addition, we had forex losses related to the weaker rand against the US dollar. The third, and Rob touched on this, was actually the Iran exchange rates and sanctions. As many of you know, the SANA rate came in Iran in the course of around August 2018, and we'd been using the CBI rate. So the average rand to Iran real was about 61% decline. So that impacted the translations of profits to group, and on closing, it was 109% lower. So that affects the value of the group receivable we still have in Iran, as well as how we equity account for that joint venture. The final is just other items that are impacting EBITDA and comparisons, and you can see on the chart there that 2017 had a couple of items, and then in 2018 we principally had the Cyprus disposal, and then also we took the CBN resolution agreement amount through the P&L, and that impacted to the tune of rand equivalent 744 million rand. Let us look at the salient points in the group income statement, and you guys will be familiar with this analysis where we compare reported and constant currency growth rates. As Rob mentioned, we had a very solid constant currency service revenue growth rate of 10.7 in the year, and reported service revenue growth of 1.1. And importantly, the constant currency service revenue growth, as Rob mentioned, is ahead of our medium-term guidance. And we're really encouraged by the positive, the 1.1% positive service revenue growth. And as I mentioned earlier, it is the first time in 2 years that we're seeing reported results positive. If you look at the EBITDA before once-off items, which gives you a better operational view of how we performed, that was 13.3% on a reported basis, and on a constant currency basis, 15.9%. That clearly shows you that we've had good expense control across our markets, and we've had service revenue growth, as Rob mentioned, well ahead of inflation, supporting EBITDA expansion. As you move down the line of the income statement, you can see some big movements, and there's a big movement there in the associates and joint ventures, and Rob took you through our strategy going forward there. I'll give you a bit more details in my latter presentation, but it's ostensibly, Irancell as well as the Jumia. Down the tax line, you can see the tax line there that, between the 2 years, there was a little movement. Last year, we reported a group effective tax rate about 52%. This year, we report 36.2% as our group effective tax rate, which is more in line with what we have said to the market is kind of the medium-term range that we expect. The CBN resolution expense, we treated as non-tax deductible, so that added to the 36.2% achieved another 1.3 percentage points. In the non-controlling interest line, you can see there a 725 million rand swing, and this was impacted by previous PPE impairments in both Syria and in Sudan. And as Rob has mentioned, the board has declared a final dividend of 325 cents per share. This is in line with the guidance of a total dividend of 500 cents per share. I'll come back and unpack some of the income statement lines in my presentation a little bit later. So let us now have a look at the financial performance of our two major operations, starting with South Africa. And as usual, the chart that you see here illustrates the service revenue, expense, EBITDA and CapEx trends in the period under review. So service revenue grew by a very encouraging 4.2%, which is now within our medium-term guidance. We had an exceptionally strong quarter four, coming through in South Africa, where year-on-year growth, if you look at the two quarters, quarter four and quarter four, that was 7.7% as the new roaming agreement kicked in. Outgoing voice was down 8% year-on-year, driven by minutes traffic, which was down 15%. Now, outgoing in the first half of the year was down 9%, so we did see some recovery in voice usage in the second half of the year, and that was supported by our CVM activity that we've been making good progress, through the year. The mobile data revenue grew in double digits by 12.7%. The data revenue growth was driven by an increase in the active database of subscriber base of 1.2 million, and we saw data traffic increase by about 41%. And when you look at the average data pricing in South Africa, that was down 25% on a per meg basis in the year. The core digital revenue declined 14.4%, and that was driven primarily by the VAS optimization program that Rob referred to earlier. The digital services such as gaming and video in South Africa did, however, continue to show good growth, so we're pretty positive about that as we go into 2019. The fintech revenues, which in South Africa currently comprise, pretty much the extra time or airtime advance offering, they grew by a very pleasing 66% for the year. While still looking at service revenue, here is a bridge view that we showed you the last time, of all the segments that build up the service revenue in South Africa. And a couple of things to highlight here on the chart. The first is that the consumer prepaid business was relatively flat at 0.2% growth in the prior year, and this is in line with the increased pressure that we're seeing on disposable incomes of consumer, particularly in the lower income segments. We're very pleased with the growth that we've seen in the consumer postpaid, and that was up a pleasing 16%, and that was on the back of net adds of 259,000 and maintained spend per customer. Wholesale had an excellent year last year, growing 82%, and again, that was supported by the national roaming deal with Cell C that came into quarter four. While the overall enterprise business declined 11%, we are very encouraged by the improved performance in the second half of the year. The improvement was largely due to new customer additions and stable churn. And on the basis of the pipeline that we've built in the business and stable churn being maintained, we do expect that the enterprise business will be back to real and positive growth in the second half of 2019. The growth in the South African business has been very encouraging for us, as Rob has mentioned. And if you were to exclude the enterprise business and just look at the service revenue growth of the balance of the business, you'll see a very healthy 6.7% year-on-year service revenue growth. And I think to Godfrey and his team, a very outstanding set of results, in driving growth and picking up the market share, which Robert says we're not giving up, going forward. Whilst the out-of-bundle price transformations was only effected for the South African business in February 2019, we do expect a couple of softer quarters to come for the consumer prepaid business before the elasticity effects start to drive revenue growth. With an improving consumer postpaid business, recovery in the enterprise business, and our wholesale business remaining strong, we continue to remain confident of delivering on our medium-term targets of mid-single-digit service revenue growth for the South African business. Then back to expenses in South Africa. You can see that cost of sales were in line with the service revenue growth. This was a result of good cost control and the benefit of lower interconnect costs due to reduced mobile termination rates. Device cost of sales ticked up due to the growth in postpaid connections of about 19%, increase in distribution and connection of higher 4G devices that was necessary to support the data growth that you saw. OPEX was up 4.8%, and that was due to the increased network operating expenses, predominantly rent and utilities. And market expenses were up, driven by our network leadership positioning, as well as the strong summer campaign that we had at the back end of last year. The EBITDA margin expanded, and that was largely as a result of the consumer postpaid performance that added 0.5 percentage points positive to margin. National roaming added another 0.6% to margin, but that was partly offset by small declines in prepaid voice and device gross margins. The capex intensity we achieved was largely as expected, and we spent 2 billion less on capex in the year, supported by price book savings, the smart capex approach that Rob spoke about earlier, and the refarming we did, the L900 deployment that Giovanni and team took across to improve 3G coverage across South Africa, and that we believe added another 5 percentage points to population coverage in the year. And as you can see, the EBITDA developments and moderated capex has supported stronger free cash flow generation in the year. When you look at EBITDA minus capex, they're a very strong result coming through for the South African business. Going forward, the level of capex is expected in the medium term to be in the 9 billion to 9.5 billion range. And the conclusion of a multi-year roaming agreement with Liquid at the end of last year ensures that we position ourselves well, appropriately for spectrum needs to meet the data demand that we see in the future. The deal that we signed with Liquid was constructed to be free cash flow neutral in the first 3 years, with potential upside in years to follow, and was very slightly in the first 2 or 3 years, margin negative. But the important thing is that it's free cash flow neutral. Okay, moving on to Nigeria. Here, to Ferdy and the team, thanks for a very strong 17.2% growth in service revenue. That's about 6 percentage points ahead of inflation. A very, very strong result from the team. The core voice market performed very well, growing about 18.8%, and this was a result of base growth, the targeted CVM activity, and the continued trend that we saw in Nigeria of voice usage as we optimize our VAS offering. Voice continues in Nigeria to represent 3/4 of our total service revenue. As Rob mentioned, we're seeing good elasticity effects in service revenue, in data revenue in Nigeria, where we saw a very pleasing 40.1% growth on the back of 56% growth in traffic. And this again clearly illustrates the data opportunity that we see in the country and the benefit of our continued investment in the 3G and 4G networks. The VAS optimization program impacted digital revenue growth, and as Rob said, this was a deliberate action that we took. The work has taken longer than anticipated, but we now expect to see digital revenue growth in Nigeria being positive, after the end of the first half of 2019. Fintech revenues in Nigeria comprise, predominantly extra time and the bank-led mobile money business, and this has had decent growth in the year. With the launch of the PSB mobile money license regime, we really believe that the fintech is going to be a revenue stream where we can expect very strong growth going forward. The service revenue in Nigeria, as I said earlier on, has been very, very strong. And so if you were to exclude the digital revenues which were impacted by the VAS optimization, what you see is an underlying growth for the balance of the revenue bearers of about 23%. So that's exceptionally strong growth in a pretty competitive market. In terms of expenses, cost of sales increased by 8%, and this was driven by high commissions and distributions, which were up 14%. National interconnect was up 12%. International interconnect was up 22%, and the digital revenue share was down 65%, consequent to the VAS optimization. The OPEX increased 14%, driven by network expenses and the recognition of the CBN resolution amount, which was expensed through the P&L for 744 Rand equivalent. We reported a healthy EBITDA margin in Nigeria, 41.9%. And again, this was a result post the CBN resolution expense. Now, the CBN resolution expense reduced margins by 1.6%. So if you wanted to see a much more operational result, then you need to add that back. And there were other exceptional items recorded in Nigeria that dragged margins by 0.9%, and that's principally the work we had done to prepare for the IPO and listing prior to the events of the end of August last year. The free cash flow development in the business was strong, and as you can see in the chart there, pretty much doubled. MTN Nigeria resumed dividend payments in February 2019, post the CBN resolution, and the MTN Group received its share of ordinary dividends, which were $141 million net of withholding taxes. So those were proceeds that have already been received. So now let us have a look at the group income statement, and starting with service revenue, and what do we see here? I think the key messages here are really that voice data and fintech revenue has been the key drivers of growth in the year under review. We've also had exceptionally strong wholesale revenue, driven out of South Africa. Voice revenue increased by 7.3%. As Rob said, this is a business and an operation where we still see voice growing. The voice growth we've experienced in 2018 is much higher than we experienced in 2017. So we're still seeing the acceleration of voice in our markets. And this has been driven by base growth, the CVM activity, and the VAS to voice shift that we've seen in Nigeria. On the data side, revenue grew 22%. And that's on the back of the network rollout, base growth, increased usage, and managing the pricing yields in very competitive markets. And as Robert said, that our active data subscriber base has grown by 10 million, which is now standing at about 79 million as of the end of 2018. The decline you see there in digital was all really driven by the VAS optimization, and Rob covered all of that, so I won't go into more detail. And there you see, again, fintech growing very strongly, just under 47%, where we saw MoMo-based growth of just over 5 million, and then we had extra time growing by 94% as we offered, as that offering was expanded across our markets. The nascent insurance business now is approximately 3 million policies, and we expect that this will be going to be a significant contributor to growth as we roll out a broader offering of financial services going forward. Moving to EBITDA, I think on this slide you can see the drivers of group EBITDA in absolute terms as well as on margin. And you see here in constant currency terms that EBITDA expanded by 15.9%. The growth that you see here was really driven by Nigeria and South Africa. The WECA region, as Robert said, was disappointing as we had competitive pressures in both Cameroon and Cote d'Ivoire. But we have good plans for recovery there for Carl and his team. The group EBITDA margin again expanded year on year, and this again were largely by the operational improvements that we saw in Nigeria and South Africa. Let us now have a look at finance costs and leverage, and I'll start with finance cost. I think the first message you see on the chart there is that the average cost of debt has been relatively stable. And this was mostly driven by a combination of lower interest income in Nigeria, and this being partly offset by lower FX losses as some of that US dollar debt in Nigeria was settled. As we look at leverage, I think there are a couple of messages we would like to make clear. I mean, the first is that we've seen a meaningful improvement in the group leverage, now at 1.3 times, and as Robert said, this benchmarks well with emerging market peers. But that said, we have always focused on the holding company leverage, and as the one that we guide on, as the majority of the debt is at the center, and associated debt servicing is primarily dependent on upstreaming from the operating subsidiaries. So the holding company leverage moderated in the year to 2.3 times from 2.7 at the back end of the prior year, and now squarely within our medium-term guidance range. We used the proceeds from the disposal of Cyprus and the Ghana IPO to reduce the US dollar term debt by approximately $400 million in the second half of 2018. I'll come back to address the resilience to stress of the holdco balance sheet and our medium-term plans to deliver over the next 3 years. As we look at the share of associates and joint ventures, you can see that the decline is primarily driven from the contribution of MTN Irancell. The Irancell contribution was impacted by about 800 million rand equivalent of forex losses as a result of the currency weakening and the change in translation rate from the CBR rate to the SANA rate, which we made in August 2018. The 340 million rand swing in tower profits is largely attributable to the recognition of a deferred tax asset for assessed losses in Uganda. The asset was recognized on the basis that the company is expected to be profitable going forward. On Jumia, the widening of losses is greater than the underlying performance given some prior year consolidation adjustments that we made. These prior year adjustments added 240 million odd to the 2018 reported losses. So if you're trying to get a more operational view, you'd need to strip those out of the calendar year 2018 and put them against 2017. And in terms of underlying performance for Jumia, we saw continued investment in marketing, and this drove growth in gross merchandise value, up 63%, and the active customer base grew by 1 million year on year to 4 million in the calendar year. The unit economics of that business, which has a focus on looking at EBITDA margin relative to gross merchandise value, improved by 5 percentage points from minus 23% in 2017 to minus 8% in 2018. Let us now have a look at the balance sheet. We committed 26 billion in capex in the period. The weakness in the closing rate of the rand resulted in foreign currency translation reserves going up by about approximately 6 billion rand. That, along with PPE additions, resulted in a 9.6 increase in PPE balances. Goodwill and other intangibles increased by 5.2%, mainly because of the Benin settlement fee that was allocated to a new license and right to self-provide fiber. Of the 1.6 billion settlement fee, 1.3 billion was recorded as an intangible asset on the balance sheet. We recorded a goodwill impairment in Yemen of 312 million rand in the year as trading conditions were particularly difficult prior to the signing of the Stockholm Agreement that is aimed at peaceful resolution in the conflict that is in that country. Looking at other non-current assets, at the year-end, Irancell had a lower associate carrying value due to equity accounting at the SANA rate post-August 2018. To help those who are going to be trying to figure out what that difference is, at the end of 2017, the carrying value for Irancell was about 10.8 billion, and at the close of 2018, about 4.5 billion as a consequence of the SANA rate. In addition, the Mascom business was classified as a non-current asset held for sale and is shown separately, as you can see there. And we also fair valued our IHS holding, as Rob has mentioned before, at 23.4 billion rand at the end of the year. Looking further down the table, our interest-bearing liability increased by just approximately 7%, and that's mainly as a result of increased borrowings at Holdco in the first half of 2018. Moving on to capex, and here I think we have a real story, and what we've said to investors all along is that we really do believe we can bring the capex profile down without compromising network quality, and I think in the year under review we did exactly that. So on this slide you can see that the absolute level of capex is down year on year, and the capex intensity is now within our guidance range. The implementation of smart capex approaches to site rollout and the U900 and R900 deployments where we're refarming low band spectrum meant that although we had lower physical sites rolled out, we increased the logical sites by 24%. Furthermore, the network spend per logical site was down 28% when compared to prior year. And I would just like to give credit to the group technology teams and the group sourcing teams we've done tremendous work in able to get us to this position where we're actually spending less and actually getting more value for the capital that we deploy. And as you can see in the chart, RAN and transmission accounted for the majority of our capex, and we continue to invest in the modernization of our IT systems, and with the most significant investment being in South Africa, where we're transforming our billing system. We comfortably delivered on the deployment programs that we have across our key markets of South Africa, Nigeria, and in Ghana. Although the capex rollout for 3G and 4G has been where the focus has been, we're ensuring that in key markets such as South Africa, future RAN and transmission deployments make us 5G ready. The price book savings we've achieved in RAN, our smart capex approach, and continuing with the U900 and L900 deployments means that we remain confident that we'll be able to drive lower capex intensity over the medium term. With regards to the holding company net debt, I'd like to make a couple of further points how it developed in the year and the resilience to stress of the current makeup of our debt. In the first, the left-hand side of the chart, I'd like to explain what drove the improvements between the first half and the second half in position. There were two main drivers to the 2.3 times result achieved at the end of the year. The first is that we had 60% of full-year upstreaming coming in the second half of the year. So we had a 40 to 60% mix of upstreaming of dividends and management fees from the markets. And obviously, that 60% excludes the Nigeria dividend, which we had anticipated to have come in the second half of 2018. The second driver has been the proceeds that we used from Cyprus and from the Ghana disposal to settle the US dollar term debt. The settling of the US dollar term debt was also important to make sure that we continue to make progress in shifting the mix of debts towards more RAN debt, which is a medium-term priority. And I think in the chart you can see that progression on the hard currency and the RAN debt is shifting. Our own view, as Rob has mentioned earlier, is that the holdco balance sheet is very well positioned, and we feel comfortable and we believe that it's resilient to stress. So on the right-hand side of the chart, we illustrate a stress scenario to the year-end leverage position that we achieved. And in the scenario that you see, we applied three shocks. I mean, the first is that, we have a 20% weaker closing rate. So a closing rate at the end of the year that would be more like just under 1730. And for those who follow the currency markets the last 5 years, I think except for one or two flashes, we haven't had the rand at that level. But that's the one shock we apply. The second shock, which is linked to the first, is that normally when if the rand was to move in that particular direction, you would see that the average ZAR to dollar rate would also move. We then apply a further upstreaming shock, another billion taken off. And last year you could assume, you could quite rightly say that there was a shock because we never got the Nigeria dividend, the rand repatriations didn't come, and the Weka upstreaming didn't come through. But be that as it may, apply another shock of another 10%. The combined effect of all those various shocks would have resulted actually in a year-end holdco leverage of 2.5 times, which would have been at the top end of our range. So as a management team, we would like to say that very clearly, before any additional actions that we may take to delever the balance sheet going forward, it is important to note that the balance sheet is resilient to a realistic set of stress events going forward. I've just covered the key drivers of holdco net debt evolution and ability for the balance sheet to withstand stress. We have actions and options that we will execute on to continue with the holding company deleverage priority. The planned disposal of Mascom is within the framework of the asset realization program. Another near-term opportunity will be simplifying the capital structure of our business in Nigeria ahead of listing. And as many of you know, that we do have a capital structure there of pref share and ords, and would like to simplify the capital structure ahead of the listing. And proceeds from both these realization opportunities will continue to be used for reducing holding company debt. Within our capital management framework, we have looked to balance the deleverage priority with an appropriate dividend policy, ensuring that the balance can work within reasonable stress scenarios over the medium term. In this regard, we believe that the dividend policy remains appropriate, And for the calendar year 2019, the board anticipates, and subject to market conditions, that the progressive dividend will be at the bottom end of the 10 to 20% growth range. The improving EBITDA and moderated capex levels will improve operating cash flows. And in our 3-year planning, where we take into account exchange rate fluctuations and possible event risks, we anticipate that operating cash flow will fully cover the dividend paid by the end of 2021. Moving on to cash flow, let me take you through a few drivers of EBITDA to free cash flow development. Included in our other operating adjustments is a payment of 3.9 billion rand relating to the Nigeria SIM registration fine. We paid the last stub of the Nigeria fine of 55 billion naira at the end of May. In 2018, the group benefited from repatriation of dividends from Iran amounting to 1.3 billion, and this was lower than the 6.5 received in 2017. No further amounts have been repatriated from Iran, and we remain with a receivable of 2.8 billion rand across multiple exchange rates as of the end of December 2018. We had cash capex of 28 billion in the year as we built out our networks, and the 12 billion that you see there of dividends paid is the aggregate of the final dividend of the previous dividend policy and the interim dividend of the new progressive dividend policy, rebased to 500 cents per share. The other investments that you see in that block there in 2018 of 5 billion was driven principally by the proceeds from the sale of Cyprus. So let me conclude my presentation by having a look at headline earnings per share analysis. And this table you're very familiar with, and it provides a reconciliation of attributable earnings per share through to adjusted headline earnings per share that reflect more visibly on operational performance. And just as a reminder, the figures for 2017 were restated for IFRS 15. If we start at the top of the table, you see that reported earnings per share of 4.85 cents for 2018. And as you work down the table and adjusting for profits accounted for in earnings, mainly profit on the sale of Cyprus and the gain on dilution of the investments in the joint venture, we end up with a reported headline earnings of 3.37 cents per share. If we adjust the reported headline earnings with all the non-operational items, we get an operational view of 6.55 cents. What has impacted this 5.65 cents has been the lower profits from JVs and associates, the weaker performance of Weka, and the stronger average rand, and these were the main drivers. If you were to strip out the currency translation effect, and we don't normally do that, from the adjusted headline earnings, actually the year-on-year growth would have been 5.1% positive. Ladies and gentlemen, that concludes my presentation, and I'll hand you back to Rob.
So I've got the easy task now, and that's talking about the future, because we've done all the hard stuff of the numbers and the results. Normally we've kind of looked at it in terms of the Bright strategy, so each element. And I think what we wanted to say today is we're still very much committed to Bright. For sure, if you look at the B, we've got all the initiatives for NPS, for best customer experience, the T for technology, returns, operational. But actually what's sitting in the I and the G is the commercial strategy of the business. Okay? How do we see the industry unfolding? Where do we see the growth? And where does our belief come from that we're going to win in those areas of growth? So that's really what I wanted to take you through. The way the framework works is we look at voice, enterprise, and wholesale under I, and the G has always been growth through data and digital. We split digital into fintech and digital. So it's a busy slide. It's got those same 6 areas, and it's a bit of a mental model for the telecommunications industry, because each curve has got a small yellow dot on it, and the dot is where do we think the industry is in the curve. It's an industry chart, it's not an MTN-specific chart. So you would see that voice, for example, we'd say is around 80% penetration. So there's still some oomph there for people penetration, population growth, but we are getting towards the end of the growth in voice. It's the biggest revenue pool of today. And the predictions for the markets from Ovum, analyst GSMA, is that revenue is going to be stable, a little bit flat over the next, stable, a little bit down over the next 3 years, 3 years out. The big growth segment for the industry for the next 3 to 5 years is access data, for sure. So they're predicting a 265 billion pool in a few years' time. We are early stage adoption. You saw it in our own base, 79 million active data customers in a base of 233, so we're at a third. Industry forecast to grow around 20. You saw our numbers 22. So much earlier stage. Then you get to the two big opportunities, the digital opportunity and the fintech opportunity. Early stage adoption, building up to pools of more than 100 billion rand between the two of them, scheduled to grow at more than 50% as mobile money becomes an increasingly penetrated service in the underbanked communities across many of our markets. And then you see enterprise and wholesale together around a 300 billion rand business, growing compound around 20%, relatively early stage. So the trick for an operator like MTN is to always make sure that we are investing ahead of the scale adoption of the curve. We can monetize the active data opportunity across our markets because we deployed large-scale 3G, 4G networks, and we're ready to receive the adoption in the customers. The same is true for digital and fintech. We have to plant those trees now so we're fit for future. We're very excited about each one of the curves, and I have just quickly a slide on each. So the first thing on voice, and I think I said it, Ralph said it, and I'll say it again for another 2 times. For MTN, voice is a growing revenue stream. 7.3%, it's an 82 billion rand business. So we have to ask ourselves, firstly, why would it grow in the market? People penetration. If you look at the penetration just of 2G voice into a population of 10 and above in a market like Nigeria, it's less than 80%. So there is still people penetration for basic voice services across our markets. Second thing is population growth. We have 660 million people across the 21 countries. It's forecast to grow by 50 million in the next 3 years. So this is an area that is basically growing another South Africa every 3 to 4 years in terms of population. It's very elastic to price, and we have youthful populations. We have more than 60% of the population below 24. So there are drivers to growth. 4 reasons why we think MTN would be successful in a business like this. Best and largest networks, largest distribution footprint, particularly to capture that last 15% of population growth. We've got a history of growing market share, and we're investing a lot in the more advanced CVM techniques. Some of the shorter-term plans are on the right. We need to push the networks out now to cover the last 10-15% of the population. Personal pricing, much more sophisticated. Multi-product selling is a big thing. Now, no more do we sell the voice and data and digital. We bundle them together. The bundling of voice into integrated bundles stimulates the category, even for a data-centric customer. So we believe MTN will be voice will be a growing business for MTN for sure for the foreseeable future. Second big opportunity is data. And again, what we say in the heading of the slide, it's the core medium-term growth driver, okay? You see it in the numbers. We've got a 125 billion rand service revenue business. There's 30 billion of data. It's growing at 22% compound. This is what's going to deliver the growth the next few years. What are the drivers of growth in the market? Very low penetration, less than a third. The networks are largely there already. We pushed our population coverage out to more than 60%. And bear in mind that our markets is not like Sandton or Cape Town or the larger metros. You know, in most of our markets, there are no fixed line networks. There's no Wi-Fi. There's no fixed substitution. These are largely not mobile first markets. They're mobile only markets for data. Exponential demand. 4 reasons to believe why MTN would be successful in this market. Again, largest data networks, because we repurpose the largest voice networks for data. That's the whole principle of U900, is you're putting 3G where there was 2G using the 900 spectrum used for 2G. That's how we get to 60% pop coverage. We've got 233 million customers to cross-sell data into. We've got a very innovative Chase strategy. Chase are the 5 limiting factors to adoption of data on a mobile network: coverage, handsets, affordability, service bundling, and education. We've got very specific plans for each one of them. What are the key shorter-term plans? Blanket of 3G coverage. Put a blanket of data coverage across the markets. Bear in mind, 90% of the handsets in our markets are 3G handsets. When the 4G handsets come in, the 3G handsets stay on the network. So you need a thick, deep pan pizza of 3G, and then you need a few pockets of LTE in the metros as the handsets start to come through. Smartphone acceleration. So you have a gift and your tables in that little bag. It's $20 3G smart feature phone. Even the analysts can accept a $20 gift, I think. Okay? The brunch will cost us more than the smartphone. Okay, so please take it with you. This is going to land in the markets around $22. Okay? This device was designed by MTN. The chipset was built for MTN. The device has been manufactured by China Mobile. We want to push millions of them out into our network. Okay? Looks like a basic phone. Our customers are used to this phone. Okay, they still know how to type with the A, B, C, D, E, F, G. I've been playing with it, nearly killed me. But anyway, it has Facebook, it has Twitter, it has Google Assistant, it has Maps, it has WhatsApp. So smart feature phone, bridging the category to bring the next 150 million into the data network. They are not all going to jump onto a touchscreen Android phone. Okay? It's too big an adjustment and the device is too expensive. $22, going to make a big difference. Please, get it onto the network. That's all we need from you. Okay? We want to see what it does on the network. We want to see how much data it uses, where it ends up. Give it away, donate it, use it. Just don't stick it in a drawer, please. Okay. Third big opportunity is digital. It's the new age digital services. So why do we think the market opportunity is there? Data adoption is growing. Digital adoption follows data adoption. There's a real demand for the services. We see it when we launch them in the markets. First thing a customer does on a smartphone, they download Facebook, they download WhatsApp, they start watching videos on Facebook, they start watching YouTube, they're suddenly on video, they're on instant messaging, they're listening to music. Very, very fast adoption, particularly for the youth again. Okay? These are born free, born digital, born mobile subscribers. They will be playing with these services while we're still trying to work out the settings. Okay? That's how it works in the markets. Why are we going to be successful? Okay? Because a lot of skeptics about this. Oh, well, you know, all these operators in Europe and the OTTs took all their money and, you know, they didn't get anywhere. I'm telling you it will be different for us. And there's 4 reasons at the bottom there. And the most important reason is the first one. And that is that we can bundle the service with the data. The biggest limiting factor for subscription media services in Africa, music streaming, video streaming, the biggest limiting factor is the underlying data consumption. No fixed line networks, no Wi-Fi, people are optimizing their bundles. It is only the operator that controls the economics of data that can bundle the subscription service with the data. It's a bedrock principle of the digital strategy. The second big thing is that we have the billing relationship. Okay? Why do you not see the OTT scaling in Africa? First problem is the data consumption. The second thing is they can't collect the subscription because 80% of the population is unbanked. You can't lodge your credit card to sign up for Netflix if you're in a remote area of Ghana. Okay? We have a prepaid billing relationship with them, so we can collect on an airtime basis, and we are launching mobile money across all these markets. The minute we convert airtime to e-money, we have the ability to leverage the system. Local knowledge and presence, and a lot of information about the customers. So some very exciting short-term plans. It's a combination of, on the one hand, building and owning our own digital services, and on the other hand, building a platform business that if you're an MTN subscriber, you can also access Netflix, Spotify, you know, whatever you may like. Big things we're announcing is the Simfy acquisition, which we rebuilt to Music Time, time-based music streaming, launched in South Africa at the end of last year. We are launching that across the rest of the markets this year. Second thing is that we've built our own instant messaging platform. We've had it on beta already last couple of months. We're going to be launching that across the market, starting with 2 of the West African markets. We are also going to integrate Momo into the instant messaging platform. Okay? So that is going to be a messaging-centric platform with payment, built, owned, managed by MTN. Very, very, very exciting development. And of course, for the digital services, also local content is key. Okay? And because we've got presence in 21 countries, much easier for us to make sure that we can curate and arrange and assemble the local content. Fourth is fintech. So I'm a reformed banker, so I can get excited about fintech. The heading is so, so important. Major driver of new value creation. okay? It's a 7.8 billion business that's going to at least double every 2 years if it grows at 40% plus. But these are also valuable businesses, fintech businesses, not trading at the same kind of ratings that your conventional telcos are trading at. So the first thing we want to do is aggressively build it, expose it to you, and then, of course, we can see down the line what we do. What are the drivers for growth? Low banking penetration, less than 20% according to the World Bank for Africa as a whole. Large cash economies. And bear in mind that our mantra for MTN Mobile Money is better than cash. We're competing with cash, trying to make it safer, more convenient, more functionality. The third factor is a big factor. Our 233 million customers are entirely used to producing cash, giving it to an agent, and giving electronic airtime or electronic voucher distribution, okay? So all we need to do is to take that airtime wallet on a prepaid billing system, once we have the right licensing, etc., and we convert that to e-money. And the minute the airtime is e-money, you can use it to pay other people, for remittances, for payments, for transfers. So that's the core, that we're leveraging an existing system. And as customers are used to recharging for airtime, very soon they will also be recharging to buy e-money. So the fourth thing, of course, is regulation. We have e-money license across most of the markets, and I think you're all aware that we applied late last year for a payment service banking license in Nigeria. We're hopeful to get that in the next few months. And so, big plans for this year, 4 new markets, SA, Nigeria, Afghanistan, and Sudan. Brings MTN fintech deployment from 14 markets to 18 of the 21, soon to be 20. Building out the merchant ecosystem. So very important when you're trying to build a business like this is a lot of the time when we talk about the customer growth, in banking terms, we're talking about issuing. But on the other side, you also have to build the merchant ecosystem to accept the payments. So in banking parlance, we call that acquiring. The open API is basically where we've very innovatively opened up the APIs for the mobile banking platform so merchants can connect to accept mobile money transactions in a couple of minutes. Okay, that's a first also for our industry. Third big plan for this year is the launch of our interoperability hub in Côte d'Ivoire. It's a joint venture with Orange. It's called Mowali. I asked what Mowali meant in the local dialect, and they said, no, it stands for Mobile Wallet Interoperability. So there you have it. All about interconnecting mobile money systems in a market, like MTN Momo to Orange, over time to M-Pesa, other systems. Very much though also for remittances, connecting the countries for cross-border remittances, both common currency, different currency, and also interconnecting all the merchants and the associations. It's an interoperability hub. It's a missing piece of infrastructure for scale adoption of mobile money across the markets. Why are we going to be the most successful player in fintech in Africa? And really, I'm just going to put it out there. Why are we going to be the most successful fintech player in Africa? 4 key reasons. We are already a scale player, okay? 1 mobile money system, 14 markets, 27 million 30-day active customers, almost 90 million registered customers, more than 6,000 transactions a minute, over $5 billion a month is going through the system. It's a scale business today, first point. Second point is that the most common customer adopting a mobile money product is actually sitting on a 2G phone, okay? This is not a 2G phone. I don't know why I picked it up, but it looks like this, okay? And so as you consume your banking products, when people say, what channel do you use, okay? You go to the branch, you use an ATM, you go to the app on your smartphone, you go onto the internet. The 99% channel for mobile money is USSD on a 2G handset. That's how they access the service. Star 136 hash, 1 enter, 6 enter, make a payment, 10 enter. Star 42 hash, how much money is there? Star 17 hash, check my balance. I made all of that up, but I mean, you get the general sense of it. The third big part is that we are repurposing an existing distribution. There's 300,000 agents across the markets that are accepting cash and dispensing airtime, okay? Once we get an e-money license and an agent banking license, that agent can not only accept cash and dispense airtime, they can dispense e-money, and they can accept e-money and dispense cash. And they can rebalance those 2 floats between themselves because they are both airtime agents and MoMo agents. The biggest limitation for the formal banking sector in our markets is the lack of distribution because it's too costly. There's too few branches, there's too few ATMs. Agent banking network is the distribution future for mobile money. And we have the network because we built it for airtime. Okay, so I have 2 curves left. You'll be, I'm sure, very relieved to know. The enterprise market. So there's similar themes here. We have a big collection of networks. It's at the bottom, why would we be successful? We have the best networks and we have the best fixed networks. You know, the whole concept of a mobile network is a complete misnomer because the network's not mobile, okay? It's a fixed network. It's got data centers, it's got terrestrial fiber, it's got core transmission, access transmission, and the access layer out to customers is an antenna. And the only thing that's moving around is the customer himself, okay? Because he's on a handset. But these are, in most of the markets, the largest fixed networks in the markets, okay? And so it's very easy to roll it out to supply fixed voice and fixed data services to corporates, which gives you the opportunity also to supply the advanced services like unified comms, ICT. So we are very well placed to be strong in enterprise. It's a fast-growing segment. You see it there. Mobile first. SMEs have been underserved. Unified comms is a big theme in our industry, and we will see it across our markets as well. What are our plan? Well, it's 4 things, but they're all so similar. We need a proper segmentation strategy. Multinationals, large corporates, SMEs, small office, home office. We need the proper product strategy for each segment, which we've been building, and we need to sell into each of the segments. It's segmentation, it's product portfolio, it's sales infrastructure, and it's sales techniques. It's really as simple as that. And the thing about this market is it's a high growth market. You saw it in the market sizing, 30% plus. We're growing, I think not too bad because we're still dragging a bit the South African enterprise anchor, which is in these numbers. But we have a structurally very low market share. Market share of MTN in the enterprise segment across all of the markets combined is less than 10%. So you run the math of, a 20 to 30% growing sector and a player that's picking up a bit of market share every quarter. And of course, you get an exponential growth in revenue. So the final curve is all about wholesale. So what is wholesale? Wholesale is when one telco sells to another telco. It's really as simple as that. Now, of course, nowadays we also sell to OTT players, okay? But it's where your customers are the people that generally you tend to most of the time compete with. We have an ambition to build a scale Pan-African infrastructure group. What are the drivers of growth? Firstly, the capacity demand is huge. So you've got a lot of single market telcos that are trying to get their data traffic out to a submarine and out and back again. So they've got a real connectivity problem. You've got the big OTTs. Our largest third-party sale in 2018 was to Facebook. Pure connectivity to pull their traffic in and out of Nigeria. There's a big migration from satellite to fiber. Satellite is just not really fit for purpose for the large transaction volumes and the large data volumes. And so what's happening across the markets is a big terrestrial fiber build. In the old days, in the 1800s, early 1900s, we were all building railway lines to get to the ports, to get things in and out of Africa. We have exactly the same thing happening in our industry. What's happening at the port is it's the landing station for the submarine cable. And the landlocked countries are trying to get their traffic to the submarine cable. That's where the terrestrial fiber build is happening. We are super, super well placed to compete there. Why? Largest infrastructure, well, already the largest infrastructure player for sure, if you add all the infrastructure together. We've got the scale for terrestrial build. If you analyze our CapEx guidance for 2019, there's R1 billion sitting in group digital and global connect. That is largely for terrestrial fiber build and some submarine capacity. We've got the local presence for sales and service in the OpCos. And of course, we also have the benefit of running our own traffic through the infrastructure. So generally, we have positive or neutral business cases on our own traffic, and then we have an exponential business case as we sell extra capacity to other telcos and OTTs. So it's a whistle-stop tour through why we're so excited about the growth. And what I'd like to do now, the last 2 slides, just sort of kind of pull that back to our investment case, what we're trying to do, and our enhanced guidance. So what you see on the slide is what we used to call historically the investment case. We're basically saying, why invest in a company like MTN? But we're calling it now really building a better, brighter, more sustainable MTN. And what you see on the top left is basically the position that we're in the highest growth geographies for our industry, the MENA region, and we have a top 2 position in every single one of the markets. And in-market scale is fundamental for our industry. And of course, we're in 3 of the 4 of the largest economies, SA, Nigeria in Africa, and we're in Iran. Of course, the other market is Saudi and MENA. So we're in the right place to be exposed to the potential to grow, for sure. On the right-hand side, we've talked about the demographics. Youthful populations, growing fast adopters of data digital, low levels of penetration of data digital and fintech, and an undeveloped enterprise and wholesale business. So the opportunities for growth are there. The strategy in the middle, the Bright strategy, has got all of our implementation of that. And I know at the time it came out, people say, oh, it's another acronym and you must have paid someone a fortune for it. Well, we didn't pay anybody for it. Okay, we did it ourselves. But please also remember, 8 quarters of consecutive earnings growth. 8 quarters in a row where we hit every single target we set for ourselves. So there is commercial momentum. I do believe we're building a track record of execution. Attractive return profile. The demographics will drive the growth. The efficiencies will drive the margin. We can manage the capex much better than we have historically, and there's no reason why we can't have significant improvement in returns. And finally, if you look at the right-hand side of the slide, bottom right, where we're positioning for long-term security, sustainability, and growth, you've got a portfolio optimization, which is simplifying the group, reducing risk, improving returns, and it's also going to generate at least 15 billion rand in disposals over the next few years. You've got the leverage brought down to 2.3, well under control, and you've got a 5 rand progressive dividend policy that is very, very comfortable considering everything I've taken you through. Growth, efficiencies, portfolio rationalization, stable leverage. So, of course, that's a lot of words, and I know that particularly our investment community like to see very hard targets and KPIs. So my final slide really is to take you through our enhanced medium-term guidance. So with our delivery up until now, with our faith in the future, we are making some changes to the guidance. First one is group constant currency service revenue growth. We had a guidance of high single digit. Remember, we set that when we were growing at 7.2. We're at 10.7. We're dragging a couple of anchors that we're going to release the next couple of quarters. So we are increasing that to double digit. Thank you, Ralph. Double-digit constant currency service revenue growth. We are keeping our guidance to continue to improve the EBITDA margin. We're keeping our guidance to bring the capex intensity down over time. We're keeping the guidance on holdco leverage. Let's keep that below 2.5. It's not particularly aggressive even at 2.5, but let's keep it in the range. Keeps everybody calm and comfortable. Helped by the asset realization program. That's a specific target. It's in my KPIs. It's in Ralph's KPIs. That money's coming one way or another. One new element on the slide is ROE. So we take also very much on board some of the investor concerns around returns, around growth, around investment discipline. Okay? We have a return on equity today of 11.5%. And we believe with the implementation of the Bright strategy and everything I've discussed, we can bring that to above 20% over the next 3 to 5 years. So that is, that's, I guess, putting our money where our mouth is. Because to hit ROE target, you've really got to deliver proper growth in headline earnings. And you've got to manage your capital well, and you can't hide behind all kinds of currency once off, this came in, this came out, 10 adjustments along the way. So we very much see that as well. And with all of that in place, we are absolutely 100% sticking to our dividend policy. Okay? It's not a complicated policy. We rebased the dividend to 5 rand. We said we'll grow it between 10 to 20%. Okay? And that's the policy. And this year you get the first 5 rand, and next year you will get, obviously, what happens after that. And we have some time for questions. I'll ask Ralph to join me up here.
Hi, everyone. It's Prashanthan from Citi. Just two questions. On the Iran repatriation, I think you said that you didn't repatriate anything more other than what you got in May. So just wanted an update on that, about the probability and possibility of getting that money out and how you're going to go about doing that. And then the second question is, I'm just looking at your contingent liabilities at I think it's around 5 billion rand. Is there anything there for the Turkcell matter, and there's a few other matters that have recently popped up? I know there was an ICASA thing as well in South Africa. If you could just give us an update on all of those headwinds. Thanks.
So, I mean, on the Iran cell repatriations, as you said, we got 1.3 billion rand equivalent in the first half. There is, across two exchange rates, so there's an amount of money that we've been guaranteed a CBI rate by the Iranian government. So that would be using the 42,000 Iranian euro, if you want to use the dollar, against the balance that we due. So that's a portion which we call FIPA protected. Then there is the non-FIPA money, which will go by the SANA rate. So a combination of those makes the 2.8. Now, as you're well aware, the sanctions came in May, and there were two windows. And the second window came in on the 4th of November. Now, what the sanctions regime says is that there are make whole provisions within the legislation of sanctions, for loans, etc., that were agreed before the May sanctions. So, we're applying a very prudent approach about, which bank and which routing we would ultimately like to take it, but we're not, anticipating that it will come in the next week or so, if that's what you're alluding to. But we feel pretty confident that that has value, and that's why it's recorded as 2.8 billion coming through. On the contingent liabilities, yeah, that's come down. I mean, what's driven that number down from the circa 9 billion odd is more good progress we've made on certain tax disputes we've had with one or two authorities. And there's nothing there for the AGF matter. There's nothing there for Turkcell. We remain of the position that those matters do not require for us to provide anything in contingent liabilities.
Wonderful. Well, thanks very much for your attendance. I think if you can just humor us, a 2-minute video to celebrate the 25 years of the brand, and then we'll be out for some coffee, and we look forward to catching up with you there. Thank you.